Imagine your business buys a machine for $12,000 cash. Does that mean your profit immediately drops by $12,000 today? Not necessarily. In accounting, there is a massive difference between spending cash and recognizing an expense. Instead, some purchases are capitalized, meaning they hit the balance sheet as an asset first and travel gracefully to the income statement over time. Capitalizing an asset simply means recording the purchase on the balance sheet as an investment, rather than writing it off immediately as a structural expense on the income statement. We choose to capitalize when an item provides a clear long-term economic benefit. This means it will help your enterprise produce revenue across more than one accounting period. Common examples include machinery, corporate vehicles, buildings, and specialized software. The rule of thumb is simple. If it helps you make money for multiple years, match the cost to those years. This is driven by a core foundation of finance known as the matching principle. We want to report the cost of using the asset in the exact same periods that we report the revenue it helps produce. By visually connecting the machine's cost to all years of economic benefit, we provide stakeholders and management with a true, undistorted picture of ongoing corporate profitability. Let's look at the bookkeeping. When you buy that $12,000 machine with cash, your journal entry is debit machinery for $12,000 and credit cash for $12,000. Notice what happened here. One asset goes up and another asset goes down. The total value of your company didn't change and no expense has been touched yet. This is where many people get tripped up. Your cash flow statement will show a $12,000 outflow right away, but your income statement shows absolutely zero change. Why? Because you haven't consumed the machine's value yet. You just traded one resource cash for another resource of equal value. Now, let's spread that cost. Assume our machine has a useful life of 4 years. For this example, we will assume it has a residual salvage value of 0 at the end of those 4 years. Under straight line depreciation, we take our $12,000 cost divided by 4 years and calculate an annual depreciation expense of exactly $3,000. This means that each year we systematically consume a $3,000 slice of that machine's original value. At the end of year 1, we make our adjusting entry, debit depreciation expense for $3,000 and credit accumulated depreciation for $3,000. The expense hits your income statement, finally reducing your profit. The credit goes to accumulated depreciation, a contra asset account that lives on the balance sheet to track the total value used up so far. So what does the balance sheet look like now? Under the asset section, we report the original historical cost of the machine, $12,000. Right underneath, we subtract the accumulated depreciation of $3,000. This leaves us with a net book value of $9,000, representing the remaining unconsumed economic value of our asset. This value continues to sit on the balance sheet, ready to help generate revenue in the years to come. This creates what accountants call the golden thread, the elegant loop connecting all financial statements. The asset lives on the balance sheet. Each year's depreciation becomes an expense on the income statement. This expense flows down the income statement, naturally reducing net income. That lower net income then flows directly into retained earnings in the equity section, which pulls down your net book value and balances the balance sheet perfectly. If we roll this forward, the process repeats identically every single year over the asset's life cycle. Depreciation expense stays flat at $3,000 annually under straight line depreciation. By year 2, the accumulated depreciation grows to $6,000 and net book value drops to $6,000. In year 3, accumulated depreciation reaches $9,000, leaving only $3,000 of active book value. By the end of year 4, accumulated depreciation reaches the full $12,000 and the net book value drops to 0. The machine is now fully depreciated, meaning its entire historical cost has successfully transitioned into an expense. The biggest mistake you can make in business is assuming that cash spent equals an immediate hit to profit. Unless an item is completely used up right away, it isn't an immediate expense. Capitalization ensures companies don't look artificially broke the day they invest in their infrastructure, and don't look artificially rich in the future years that they use it to generate revenue. It keeps your financial reporting balanced, aligned, and completely honest. To capitalize means to record a purchase as an asset first and then expenses gradually through depreciation. Once you map out this flow, the bridge between cash, assets, and profits becomes a crystal clear. Thanks for watching. This is Accounting 123. Hit subscribe and I'll see you in the next lesson.